Hi, everyone. I hope you're having a good week. This week's subject is stock splits. Now, perhaps you've seen companies, for example, in the S&P 500 announcing plans for a stock split in the news. They usually do make the news, especially when it pertains to a well-known company. Interestingly, fewer and fewer companies have been doing stock splits in recent years. In 1997, 102 companies split their stocks, while only 7 companies did so in 2016. So maybe you own a stock that is going to split its shares and have wondered how this action affects your portfolio. As can be seen, splitting shares is something less common, and it's helpful to understand, though, the reason for the splits if it does happen to you in the future. A stock split is a corporate action that a company board of directors has decided to undertake. A stock split can be used to lower the price of a share of company stocks. Each share of stock may now become more than one. For example, a 2-for-1 split, for every 1 share an investor owns, they are given another share they own too. Although if the shares were worth $100 each after the split, they're now worth $50 each. So as you can see, it doesn't really affect your price of the shares or your value of the shares in the company. Now, most common stock splits are either 2-for-1 or 3-for-1. Now, what's the incentive for a company to do a stock split? Now, some companies want their shares to be more accessible to investors, so they'll enact stock splits when their share price goes up. Now, once the price of a share reaches a certain height, the company might consider it less affordable for investors wanting to purchase a small amount of stock. To adjust the price, they can do a stock split. Now, with the stock price less per share, more investors can now afford to purchase it. A stock is often easier to buy than sell at a lower price. This could increase the liquidity of the stock. Also, more investors may be able to buy the stock, potentially increasing the demand for the stock, which could, doesn't always happen, increase the price of the stock. A split could signal to potential investors that management is confident in the company, which could increase demand for the stock. It could also bring the stock price into line with the company's competitors. Now, a company might also undertake what's called a reverse split, which is the opposite of this. Instead of decreasing the price per share, a reverse stock split increases the price. Now, this process will create one share from several. One reason a company might decide to do this is to meet a stock exchange's minimum share price requirement. A company might want to stay on a particular exchange. Their stock price may be too low, and by doing this adjustment, they could potentially get to stay on the exchange, and that could work to their benefit. So after reading this, you might think stock splits lead to greater value in stock holdings. Now remember that the stock's overall value remains the same after a split, and it is only the price of the share that will change. Stock returns generally change with business prospects and market conditions. A split may have little impact on the stock's fundamental value. It should also be noted that a stock's past performance is really no guarantee of its future performance. So keep this in mind as you review any stocks in your portfolio undergoing a split.